Hello, and welcome to my video. The topic of today's video is using other tax-free vehicles to invest for a child when you cannot deduct the contributions you make to a 529 plan. My name is Mike Hannafin, and I'm a financial consultant at Equitable Advisors in Saddlebrook, New Jersey. And if you're watching this, as I said before, you probably make too much to deduct whatever contributions you can add to a 529 plan, which naturally begs the question, why would you invest in something like a 529 if you can't make those deductions? Why would you trap your money in a 529 if you couldn't make those deductions? So of course you want to explore potentially other more flexible tax-free vehicles with similar compounding and high contribution potential. But there are only so many tax-free options that anyone could take advantage of. And the one that I'm going to be showing in great and honest detail today is 7702, or cash value life insurance. I'm going to show you a detailed illustration that goes right down to the detailed potential costs and benefits of something like this. So before we get into the nitty-gritty detail, let me make two quick prefaces. The first preface is, don't attempt this if you're not a mostly healthy person. And by that I mean you have a combination of a good BMI, blood work, family history, etc. Why? Your underwriting class in something like life insurance determines expenses, so if you don't get a decent one, the money will not compound properly. Second preface I'm going to make is that this is just an illustration, right? I am not promising anything when I show you all of this. That said, it is a very detailed and comprehensive illustration. So let's set the scene a bit. So here we have a healthy 30-year-old male that is contributing $800 a month for 17 years. There's a few things that you may notice, or that I want you to notice right off the bat. First, towards the bottom there, you see that there's this no-lapse premium of around $280, which means that this, if you run into a cash flow issue, this is flexible. When you're planning on contributing $800, but the minimum you only have to contribute is $280, that makes this policy a pretty flexible policy. Second is that there's this weird face amount that's around $470,000, but not quite there. I designed this to have a fluctuating face amount so that you can, one, have the expenses be as low as possible, but two, be funded enough that it doesn't become, as you can see at the bottom there, an MEC, which this is not. And what is that? An MEC stands for Modified Endowment Contract. Essentially, if you overfund these things, you don't have a high enough face amount relative to what you're contributing, this can be taxed like an annuity, and it would completely defeat the purpose of what we're doing. So this is not an MEC, so that's what we want. But what am I saying here? All I'm saying is that I designed it in such a way so that expenses are low as possible, but it remains to be tax-free. If you're a curious person and you want to know more on the subject of how life insurance is taxed or about modified endowment contracts, check out IRS Rule 7702. So let's get right into the values and benefits report. First thing I want you to notice in the upper right there is that that return I programmed in at 8% gross, 7.31 net after fund expenses. I'm not willing to go higher than 7 or 8% when I'm making any of these illustrations. I think it's realistic, but do I think it's beatable? Yes, I do. So over on the left, you'll see that contribution of $800 a month or $9,600 a year from year 1 to year 17. Then on year 18, I show what it was like to take maximum withdrawals for 6 years. Why 6 years instead of 4? Just in case the child wants higher education like a master's degree. And it came out to about $50,000 a year taken out for 6 years, which means that in total at the bottom there, you can see that $163,200 was contributed into the policy. And this person got nearly $300,000 of completely tax-free money that they can spend on whatever they want. And you'll see on the taxation report that I programmed into this illustration that if this policy went to year 95, or when the client is 125, that there would be no taxes owed on any of these withdrawals. And that's actually a rather big and important note and great benefit. This policy will and should stay in force until the end of the client's natural life. So whether the client is 30 years old or 125 years old, they're going to get that tax-free death benefit. Moreover, too, there's lots of fund and investment choices in something like this. You can invest in different balanced funds, different index funds, or even sector-specific funds. And this is one of the downsides of the 529. You really have little to no control over what you're actually investing in. So if you're someone that likes control and options, this is a good option for you. So at this point, you might be saying to yourself, Michael, I like everything you're saying, but you're only going over the positives. That's fair. Why don't we jump right into the cost of something like this? So here is the detailed cost report. I want you to focus on the what we deduct section and all the columns below that, minus the loan interest one. And something like this, when you take a loan in the policy, you'll see, yes, there is loan interest, but we just credit you that interest. It's called a wash loan, and it just makes it effectively a withdrawal. But other than that, there are a handful of other charges there that are pretty significant within the first 10 years or so, but tend to drop off after that. You have to remember that this is still life insurance, and the company still needs more money up front to make sure that it properly invests so that it's ready for you to die at any given moment. Plus, in year 20 of the policy, if you look at the right column there, there's a customer loyalty credit that kicks in that starts to seriously reduce a lot of the expenses year over year and help keep the policy in force thereafter. So I will certainly say that relative to the expenses of a 529, that the 529 relatively has better compounding potential. But how much better? If we were to break it down in actual numbers, how big would the difference be? So to determine this, I programmed in the same scenario into Excel with varying levels of expenses, since depending on what state you're in or if you have a broker, expenses can vary. And the cumulative withdrawal differences ranged anywhere from $6,000 to, or in this illustration, close to a cumulative $11,000. Or what that equates to is about $1,000 to $2,000 extra dollars to spend in a 529 per year. So not a massive difference when we're talking about the cost of college, but there is obviously a difference here that you have to consider. The 529 obviously has more favorable expenses and therefore probably better compounding potential. But I believe that's where its advantages end. The life insurance is a lot more flexible, both in regards with its investment control and what you can spend the withdrawals on. You can spend the withdrawals on anything. It doesn't even have to be college. And moreover, it doesn't have to be what a 529 considers a qualified expense. Plus, not to mention, if you look back on the values and benefits page, you get that added benefit of the death benefit, which means if you die younger, college is funded for your child. If you die older, you can use it to cover estate planning costs, for instance. So there is a lot to consider here, and my opinion doesn't matter as much as your personal situation, but I don't see why someone personally would trap their money in a 529 if they weren't getting some kind of deduction out of it. So if you made it this far, I want to thank you for getting to this point. If you didn't like what I had to say, no worries. I wish you well, and I wish you wealth and prosperity. That said, if you see the obvious utility and you fit all the characteristics that I mentioned before, then click the button below to go to my calendar, select virtual tax-free child savings meeting type, and let's make a plan together. You will be speaking to me directly. I obviously made this video myself so that I could personally connect with more clients and be honest about things like this, but I am just one person and my schedule can fill up kind of quickly, so grab your slot now. Alternatively, also, I do make other videos, and if you found this particular video helpful and you're the type of person that defers a lot of their income now, I have another video on planning to pay for that deferred income tax in retirement or when RMDs sneak up on you. So if that sounds interesting, scroll down to the bottom of the page and check that out too. Thank you so much for watching and have a lovely day.